Welcome to America's Commercial Real Estate Show, your source for market intel, forecasts, and strategies. Hello, I'm Michael Bull. Thank you for being with us. The segment is brought to you by Buxton. Check it out for their mobile and predictive analytics. It's really crazy what you can do with their information. It tracks all the smartphone traffic. If you haven't seen it, check it out. Their website is buxton.com. And you can also use it for a lot of advantages in retail. And we're going to talk about retail today. And I think retail is something that has surprised a lot of people, especially if you're not in the sector every day. You know, how well sales have gone and rents and occupancy. But we're in a changing environment, right? A changing economic environment, rising interest rates. So what's going on now, and what should we expect in the future? Please welcome my guest. It's Thomas LaSalvia. He's senior economist with Moody's Analytics. Tom, thanks for joining us, sir.
Hey, Michael. It is absolutely a pleasure to be with you today. One of my favorite things is to join your show. So thank you for having me back.
All right. And thank you for being on the show. We love your insight, and, it's not just looking at the numbers. It's like, well, what's impacting it and what should we expect in the future? It's like, what's the old saying, you got to skate where the puck is going, right?
Certainly. And this retail puck is quite intriguing in some ways, maybe a little dull in others.
Well, let's look at performance first, because I kind of open it up with suggesting that rents and occupancy have been doing well. What's kind of the latest picture?
Yeah, I would say relatively well. And that's where my statement about dull comes in a bit. If you look at the vacancy rate, we're a shade above 10%, which is not very far off of what we were pre-pandemic, actually, within 10 basis points. And, we saw early in the pandemic a little bit of an increase. And over the last year and a half or so, slowly but surely, we've been inching our way back down to around that 10% mark. And this is specifically neighborhood and community centers. For regional malls, we're around 11%. And again, this, as you said earlier, this surprises many people because there was this whole push for e-commerce, this negative rhetoric associated with malls in particular, but generally, at least at the national average level, it's pretty flat from the occupancy perspective. And if you dig in where it's more fascinating, there's a pretty big distribution around those occupancy levels where you'll see some super regional malls that are incredibly successful, where there is essentially a waiting list to get in that mall. And then others where you'll see vacancy rates, unfortunately, 70%, ones that are absolutely failing. So, large distribution around what's happening with occupancy, but generally in the middle, it's flat. Turning the attention to the rent side of things, it's pretty similar story. We saw some rent declines through 2020 into early 2021. And little by little, a tenth of a point, 20th of a point, here or there, percentage point going up for rent levels. We've basically recovered. Again, that's at that national average level. But if you look at the distribution and you look at it from a property perspective, there are absolutely winners where rent levels are increasing substantially. And there's losers where the property owners, the landlords, they're not even close to keeping up with the level of general inflation and operating expenses. And so those properties are seeing a dip in net operating income. So again, dull if you just look at the national level stats, but really fascinating if you start digging into property level stats.
Yeah, and that's really interesting. I was talking to a bankers association last Monday, and one of my advices to the lenders was to be very particular and specific about each property and the tenants and what's going on in each individual property, because things can vary wildly, and you can miss some opportunities if you kind of ballpark, say, office or retail. Oh, we're not doing any of that right now. Well, you might lose a great customer. And one of the things obviously that drives retail rents and occupancy is how well the retailer's doing. And so, what do you see?
Yeah, so this is also quite interesting. Through 2021, goods purchases were very, very strong, right? We were still in the midst of the more of the lockdowns, more of people being at home, working from home, fixing up their houses, right? This is when Lowe's, Home Depot were doing fantastic. Lumber prices were going through the roof, et cetera. And in 2022, especially come late spring and through this summer, we definitely saw a shift towards more service-oriented spending. Overall spending levels stayed fairly strong, actually, considering some of the negative rhetoric, considering the negative GDP growth that we saw in the first 2 quarters. So consumers are out there spending. It's that at least in the summer, they shifted towards services. They shifted certainly towards leisure. I mean, I know we're not talking hotel, although hotel is very linked to retail in a lot of ways. We saw record levels of room rates and very high occupancy rates during the summer. And so you can imagine retail, when it came to restaurant spending, when it came to other experiential spending through the summer, that was incredibly strong. Now, as we move forward, I think it's really going to be interesting what happens in these next few months, the holiday season. My expectation, a little bit of a slowdown when we see the September data, but then I think it's going to ramp up considerably October, November, right into the holidays at the end of the year. So I may be in the minority here, but from a retail spending perspective and how this affects brick and mortar, I actually expect quite a good holiday season.
Well, that's promising. That means people are still confident, right? The consumer's confident, and the retailers are doing well.
That's so interesting, because if you look at the surveys, consumers aren't that confident, right? So if you look at the University of Michigan survey and some of the others out there, consumer confidence is still near record lows, although it's come up a little bit in the last few months, the last few surveys. So, they're confident if you look at it from, hey, they're still spending. But their surveys are showing that they're not happy with the inflation, right? And so I think that's why the survey numbers are so low. They're expressing their dissatisfaction with inflation. But you know what? If we're still adding 250, 300,000 jobs each month, if the openings to unemployed ratio is still near 2 to 1, which it is, while we expect that all to soften over the couple of months, we're not going to see a big spike in unemployment or a ton of job losses through this holiday season. So I expect, again, people will keep their jobs and they're going to want to keep spending. Prices obviously are still quite high and they're still going up. Unfortunately, the Fed's job is really tough. But consumers are willing to keep spending at this point. And I think that continues over the next few months before maybe we get some deeper softening in 2023. But a lot of that depends on how quickly the Fed can get inflation under control.
Yeah, and here's my advice for all the politicians listening. Let's do some things to reduce gas prices, because the gasoline and oil prices can impact so much of everything. Everything has to be delivered in some way, and that would certainly help. Tom, what are some of the tenants, particular tenants or types of industries that are expanding right now in retail?
Yeah, this is another story of haves and have-nots, or a wide distribution of what's going on. Generally, apparel hasn't been doing great, but when you look at a company like Primark, the Dublin-based company that's making inroads here in the US, I think they have around 15 stores now. They're really moving forward with this fast fashion, fairly discounted cost clothing, and it's trendy right now, to the point where I was in a mall about a year ago. This is still in the pandemic situation, a little deeper, where they were limiting the amounts of people that were going into certain stores. And there was a line outside of this Primark. So, and there's other stores that we've seen like that as well. So it's very interesting to see the change in trends or the evolution within retail, right? I mean, we know the troubles of JCPenney's. We know the troubles of Macy's. Kohl's recently has been in the news for the troubles, and they're going through some restructuring and changing of what their business model is going to look like. Bed Bath & Beyond is struggling, right? But there's others, even within those same categories, that are actually doing well. And I go back more to apparel than anything else, apparel and footwear, because you can see a company like Primark making inroads, Uniqlo making inroads, where some of the others are actually, reducing. There's a competitive element to this, right? And consumers in particular, when it comes to fashion, they love what's new and trendy and interesting. And so I think we're just seeing that evolution take place. I'll give you one more store that actually is interesting, or an online retailer who's now going into bricks and mortar, which is Allbirds, right? The sneaker company. So they, started selling direct to consumer. And I think now they're planning, they've either opened or are planning around 15 to 20 stores in the US. So really interesting to see how there's winners and losers. But to me, it's more of just, this is an evolution of retail. Things move with the trends. There's a competitive element. When somebody's doing something new and interesting, right, they have the chance to expand. And when others have maybe, not been as innovative as necessary, those are going to recede a little bit and have to reinvent themselves to compete. So, again, haves and have-nots. This is not a rising tide lifts all boats, or a receding tide dips all boats, or however you want to say it. Usually don't say it that way. But it is certainly a story where there's winners and losers.
Yeah, and in apparel, it makes sense that it should be improving, because so many people now are going back to work and they're traveling more, and and either a lot of people gained weight during COVID, they may need new clothes, or lost weight. I lost 35 pounds in the last year myself. So I've been out having to buy clothes, and it's frustrating that, well, I guess it's a good thing, but I think the apparel should continue to do well. And we're talking with Tom LaSalvia, a senior economist with Moody's, and we're talking about the retail world around the U.S. and some of those tenants expanding. That's good news. And the other aspect that people are curious about, my listeners and viewers, I think, are what's happening with valuations, or if you want to talk in terms of cap rates. I know you're just finishing up kind of the third quarter results on your investment sales numbers, but what are some trends you're seeing so far in cap rates for retail properties?
Yeah, there's upward movement, and I think that's expected given where the risk-free rate is going. If the Treasury is going to be hitting 4%, which it touched recently, receded a bit, but likely to continue to move up a little bit, the 10-year Treasury. We're seeing cap rates at the end of Q2. We saw them in the mid sixes into the sevens on average here. But again, there is a wide distribution. I hate to keep going back and saying that same thing over and over, but it's very true in retail, maybe more than any other sector. Even when you look at the mean versus median cap rate, right? The median was in those mid sixes, but the mean was above 7 to 8%, telling us that there were some properties trading at double-digit cap rates, and quite high ones that were skewing that mean, right? And then on the other side of it, we're still seeing some properties trade as low as 4%. So, I mean, this is really interesting, getting to the point where we actually have a negative spread between the risk-free rate and the cap rate, right? It's more pronounced, certainly in multifamily and industrial, where we're seeing those. But even in retail, some of the really value, there's really strong properties out there that are still trading at strong valuations.
Yeah. And to help the listeners put it in perspective, what's that difference in cap rate when you look at, say, last year when we had a very, very robust investment sales market?
Yeah, so we were looking at cap rates still, mean and median still in the fives. So we're moving up. We're trending up, 100 basis points. We're likely to see another 50 to 100 basis points being added to this before all is said and done with the increasing of interest rates, which we expect to continue into 2023 before maybe taking a dip late in 2023 into 2024. So yes, we look at it this way. Commercial real estate is still an excellent investment. But when the risk-free rate is doing what it's doing at this point, there has to be some upward pressure on cap rates, pretty much across the board. But again, there are properties that have been able to increase rents that are nearly fully occupied. And so their income is increasing and their property values can still be increasing, and those cap rates, right? It's always that ratio of those two, but those cap rates are able to stay fairly low in those fives or even dip into four. But then there's the other side of it where the rents aren't increasing at all. And if those cap rates are increasing for those properties, that means there is a little bit of haircuts being taken. And so again, we overall think that just generally commercial real estate's in a strong position, even if we enter a mild recession. But because unfortunately, the remedy to the high inflation are higher risk-free rates, that necessarily places that upward pressure on cap rates.
Right. Yeah, I agree. Real estate's, I think, maybe a safe investment if you're considering some volatility in the market out there, because we have the principal reduction on the loans and the inflation and the benefits long term of that. I was interviewed the other day on a show, and they asked me, what's the biggest mistake you've seen investors make? And it kind of caught me off guard, but I thought about the history of my career of 35 years and about $8 billion in sales, and I think the biggest mistake I've seen is people looking at the individual timing of the market and not thinking more long term. Right? Oh, I'm not going to pay 6.2 cap. Cap rate, that's 20 basis points off. Wait a minute. If it's a good property, your long term hold, it's probably not going to matter at the end of the day.
Yeah, completely agree with that sentiment. This is commercial real estate, and I know the holding period, may not be long for certain investors, but for others, there's fantastic properties out there that have a very, very strong runway. And I completely agree that, there's still value to be had, and there's still good potential when we look out over the next 5 to 10 to 15, 20 years. So a lot of it depends on the holding period and the type of investing that you're looking to do. But yeah, there's a lot of good opportunity still.
Yeah, and I think it's interesting what you mentioned, that we've heard about from the Fed about potential rate increases going up even more, and we're in the day-to-day negotiations of deals at our shop around the Southeast, and even though we're in very strong markets, we're seeing cap rates rise, and we think as more and more of these sales are reported, we're going to continue to see cap rates rise. And to your point, individual to specific properties. But if interest rates are going to be even higher, in 6 months, then if you are a seller, then maybe you're doing it now. It's kind of an interesting market, isn't it?
Yeah, that's absolutely true. And we're still seeing pretty robust retail sales. We're seeing, a little bit of a dip from 2021 in terms of sales, originations, but still very strong on the retail front. And, this might be the moment to get out there and potentially make that purchase if you could find that good deal.
Yeah. And this might sound like I'm a broker, but also could be a time to sell before rates even go even higher. And you think about it, the rates really historically, really, you look at it that way, they're not high.
Right. That's something that us older timers realize, right? I mean, when we look back a couple of decades, or a couple of decades, we were seeing rates right around this, right? I think it was the early 2000s when's the last time we saw this. But a lot of people that are new to the industry, they're very used to, you know, mortgage rates being in the 4s and 5s, and risk-free rates being less than 1%, right? I mean, so a lot of it is recency bias. And I think that's what scared off quite a few folks, is when they see a cap rate 7, 8%, when they're seeing financing rates, you know, up there, then they're saying, wait a second, you know, I don't know if I can make this work, right? I don't know if this can pencil. And there are others that have been in this industry a long time that find ways where they can get the financing for that project you were talking about earlier, right? That strong project that has a longer runway for success.
Yeah, I remember when show my age when we could get a 12% interest rate, and we were just very, very excited to have that low of a rate. I once had a property myself with the interest rate at one point was 17%, and I did well with the property. So yeah, you don't want to just freeze up just because rates are a little higher than you're used to in recent times. Well, Tom, what would you leave our audience with to think about moving forward for the retail world?
One of my favorite discussions in retail right now are the transitions or the redevelopments towards lifestyle centers. I find this absolutely fascinating. And one of the reasons is because I'm kind of an urban romantic, but urban to me does not have to mean a big city. I love walkability. I love that idea of the 15-minute city, right? Where you can kind of get anywhere on foot or bike within 15 minutes. And so that could even be a small neighborhood where you can go to the shops, you can go to restaurants, and pretty much do everything that you want. And so I'm very intrigued by what I am seeing with some of these older retail properties, in particular kind of mid-size and smaller regional malls that are failing. A lot of investment is going into redeveloping those with a bit of multifamily right there, changing kind of the look to have a little more of a vibrant outside, right, and walkable from those apartments now to where the shops are. So it's this interesting mixed use lifestyle center that I am seeing, for one, new developments happening, but two, seeing a lot of redevelopments across the whole country in this fashion. And it's an interesting model, right? Because if these early entrance into this redevelopment process succeed, then that's a model for investors and financiers to go ahead and greenlight more and more of these projects. And again, for me, who I've studied location choice all my life, where households live, where businesses locate, is this really a model that has staying power? Right, and is going to be something that we continue to watch over the next years and decades, for that matter? Is this the next big step in evolution in retail, as we've gone from, way back when it was just the downtown stores, to then the regional malls picking up, to the power centers, and now, and then outlets and so on. And now are we going into this interesting lifestyle mixed use where every property, or many of them anyway, are going to have elements of a lot of the different sectors, really blurring the lines across the different real estate sectors. So that to me is really interesting to watch. Are these properties, are these redevelopments really going to succeed?
Yeah, I think I agree with you, Tom. I mean, I have a home on Lake Lanier, suburban Atlanta, and then I have a place in town that is in a mixed use, and it's really, really convenient. It's really, really fun and exciting, being a mixed use development. So I think, if you have a company or a housing option where you're in a mixed use type environment, even if you're not in a big city where you are mixed use, then that has a lot of advantages to be able to walk out of your office or your home and walk the things. I think it will continue. And you look at, a lot of these retail properties, to your point, they're very well located and they're big enough that you can create really your own community right within the property.
Yeah, I've even seen governments, local municipalities get involved where they were traditionally a suburban municipality, right? And they want to create, I'm going to use air quotes here, they want to create a downtown. And so they're taking this old, large, well-located mall, and they're creating a downtown, putting municipal building offices there. And then there's going to be shops, restaurants, there's going to be a theater, or there's going to be, a bandstand or something and a mall, a green mall, not an indoor shopping mall, but a space for people to picnic and listen to bands. So it's very interesting, again, to see this mixed use take off.
Yeah.
And to see the runway for it.
That's right. That's awesome. Well, Tom LaSalvia, thank you. Great information as usual. Thank you for being with us, sir. More information from Moody's Analytics. And it used to be Reese, if they're more familiar with Reese. You can reach their website and it's cre.moodysanalytics.com. And of course, you're welcome to visit our site. It's creshow.com and connect with us on your favorite social media. Hey, we sure appreciate hearing from you. If you have any questions or suggestions or want to reach out to me, my email is michael@bullrealty.com. So until next week, be sure that you always lead, learn, and laugh, and join us for America's Commercial Real Estate Show. America's Commercial Real Estate Show is brought to you by Buxton. Take leasing, site selection, and due diligence to the next level. Make the right decisions with on-demand mobile data. Visit buxtonco.com. By Bull Realty. For proven commercial real estate asset and occupancy solutions, contact me. My email is michael@bullrealty.com. By Commercial Agent Success. Expert level commercial real estate broker training. Cloud Access 1, up to 21 one-hour videos. Visit commercialagentsuccess.com. Thank you for reviewing, subscribing, and sharing America's Commercial Real Estate Show.